Question 1. An investor in a high tax bracket would most likely benefit from investing in which of the following? A. Corporate bonds. B. Preferred stock. C. Municipal bonds. D. U.S. Treasury bonds. Answer: C. Municipal bonds. Municipal bonds are typically exempt from federal income tax, and often from state and local taxes if the investor resides in the state of issuance, making them very attractive to investors in high tax brackets. This tax-exempt status allows an investor to keep a larger portion of their investment income compared to taxable investments like corporate bonds or U.S. Treasury bonds. For instance, if a municipal bond offers a 4% yield, that 4% is entirely tax-free, which could be equivalent to a much higher taxable yield depending on the investor's tax bracket. Always consider your tax situation when evaluating investments, especially for income-generating securities. Question 2. A municipal bond's official statement is considered the primary disclosure document for the bond and is similar in purpose to which of the following? A. A stock certificate. B. An annual report. C. A prospectus. D. A quarterly earnings statement. Answer: C. A prospectus. The official statement for a municipal bond serves as the primary disclosure document provided by the issuer, containing detailed information about the bond offering, the issuer's financial condition, and the project being funded. This document is similar in purpose to a prospectus for a corporate security, which also provides comprehensive disclosure to potential investors. For example, before you invest in a new bond, the official statement gives you all the essential details to make an informed decision, much like a prospectus does for a stock IPO. Always review the official statement thoroughly before investing in municipal bonds to understand all the associated risks and terms. Question 3. What is the tax status of interest income received from a general obligation bond issued by a state in which the bondholder resides? A. Exempt from federal tax only. B. Exempt from federal, state, and local taxes. C. Subject to federal tax, but exempt from state and local taxes. D. Subject to all federal, state, and local taxes. Answer: B. Exempt from federal, state, and local taxes. Interest income from municipal bonds, including general obligation bonds, is generally exempt from federal income tax. Furthermore, if the bondholder resides in the state where the bond was issued, the interest is typically also exempt from state and local income taxes, often referred to as triple tax exempt. For example, if a California resident buys a bond issued by the state of California, the interest earned would not be subject to federal, California state, or any local income taxes. This triple tax-exempt status makes in-state municipal bonds particularly appealing to residents of states with high income taxes. Question 4. Which of the following statements about revenue bonds is true? A. They are backed by the full faith and credit of the issuing municipality. B. They are secured by ad valorem taxes. C. They are typically used to finance projects that generate revenue. D. They require voter approval for issuance. Answer: C. They are typically used to finance projects that generate revenue. Revenue bonds are municipal bonds issued to finance specific projects, such as toll roads, airports, or hospitals, with the debt service primarily paid from the revenues generated by that specific project. Unlike general obligation bonds, they are not backed by the full taxing power of the municipality. For example, revenue bonds issued for a new bridge would be repaid using the tolls collected from vehicles using that bridge. Understanding the specific revenue source is crucial because the bond's safety depends directly on the project's financial success. Question 5. Which of the following would be least likely to be considered a source of revenue for a general obligation, bond? A. Property taxes. B. Sales taxes. C. Tolls from a newly constructed bridge. D. State income taxes. Answer: C. Tolls from a newly constructed bridge. General obligation, GO, bonds are backed by the full faith, credit, and taxing power of the issuing municipality, meaning they are repaid through general tax revenues like property taxes, sales taxes, and state income taxes. Tolls from a newly constructed bridge, however, are a specific revenue stream generated by a particular project and would typically be used to back a revenue bond, not a general obligation bond. Remember, GO bonds rely on the municipality's overall ability to tax its residents, whereas revenue bonds depend on the success of a specific enterprise. Question 6. A municipal bond with a par value of $5,000 is quoted as 102. What is the dollar price of this bond? A. $102. B. $5,000. C. $5,100. D. $5,000.10. Answer: C. $5,100. Municipal bond quotes are typically expressed as a percentage of their par value. A quote of 102 means 102% of the bond's par value. To calculate the dollar price, you multiply the par value by the quoted percentage. For a bond with a $5,000 par value quoted at 102, the dollar price would be $5,000 x 1.02 equals $5,100. This calculation is essential for determining the actual cost an investor will pay for a bond. Question 7. The primary source of revenue for a general obligation bond is typically A. Lease payments from the financed facility. B. User fees from specific services. C. Ad valorem taxes. D. Special assessments on benefiting property owners. Answer: C. Ad valorem taxes. General obligation, GO, bonds are debt instruments issued by states, counties, or cities that are backed by the full faith and credit of the issuer, primarily supported by their taxing power. The most significant source of revenue for repaying GO bonds comes from ad valorem taxes, which are property taxes. For example, a city issues GO bonds to build new schools, and the bond payments are largely made from the property taxes collected from its residents. Understand that ad valorem literally means according to value, referring to taxes levied on property values. Question 8. Which of the following is responsible for appointing the bond counsel for a municipal bond issue? A. The Municipal Securities Rulemaking Board, MSRB. B. The underwriter. C. The issuer. D. The trustee. Answer: C. The issuer. The issuer of a municipal bond is responsible for appointing the bond counsel, who is an independent law firm specializing in municipal finance. The bond counsel's primary role is to ensure the bond issue is legally sound and to provide a legal opinion as to the bond's validity and tax-exempt status. For instance, a city issuing bonds for a new infrastructure project will hire bond counsel to confirm the city has the legal authority to issue the bonds and that the interest income will indeed be tax-exempt for investors. This legal opinion is crucial for the marketability of the bonds. Question 9. An investor living in New York City purchases a general obligation bond issued by the state of New York. The interest income from this bond is A. Subject to federal tax only. B. Exempt from federal, state, and local taxes. C. Exempt from federal and state taxes, but subject to local tax. D. Subject to all federal, state, and local taxes. Answer: B. Exempt from federal, state, and local taxes. Interest income from municipal bonds is generally exempt from federal income tax. When an investor purchases a municipal bond issued by the state or a political subdivision within the state where they reside, the interest income is often also exempt from state and local income taxes. This is known as triple tax-exempt status. Since the investor lives in New York City, a political subdivision of New York State, and bought a New York State bond, the interest will be free from all three levels of taxation. This tax advantage makes in-state municipal bonds very appealing for residents of high-tax states. Question 10. Which of the following is not a characteristic of a municipal revenue bond? A. Backed by the full faith and credit of the issuer. B. Issued to finance self-supporting projects. C. Debt service paid from user fees or project revenues. D. Requires protective covenants. Answer: A. Backed by the full faith and credit of the issuer. Municipal revenue bonds are debt instruments specifically designed to finance projects that generate their own revenue, such as toll roads, airports, or water systems. Unlike general obligation bonds, they are not backed by the full faith and credit and taxing power of the issuing municipality. Instead, their debt service is paid solely from the revenues generated by the financed project. Therefore, option A describes a characteristic of a general obligation bond, not a revenue bond. Question 11. An investor is comparing a taxable corporate bond yielding 6% with a tax-exempt municipal bond yielding 4%. If the investor is in a 25% tax bracket, which bond offers a better after-tax yield? A. The corporate bond, as its after-tax yield is 4.5%. B. The municipal bond, as its after-tax yield is 4%. C. Both bonds offer the same after-tax yield. D. More information is needed to make a determination. Answer: B. The municipal bond, as its after-tax yield is 4%. To compare a taxable bond with a tax-exempt municipal bond, you need to calculate the taxable equivalent yield for the municipal bond or the after-tax yield for the corporate bond. For the corporate bond, the after-tax yield is 6% asterisk, 1 to 0.25, equals 6% asterisk 0.75 equals 4.5%. For the municipal bond, the yield is already tax-exempt, so its after-tax yield is simply 4%. In this scenario, the corporate bond's after-tax yield of 4.5% is higher than the municipal bond's 4%. The question asks which bond offers a better after-tax yield, which is the corporate bond. Question 12. Which of the following is generally considered the safest type of municipal bond? A. Industrial Development Revenue Bond, IDRB. B. Special Assessment Bond. C. General Obligation, GO, Bond. D. Hospital Revenue Bond. Answer: C. General Obligation, GO, Bond. General Obligation, GO, bonds are typically considered the safest type of municipal bond because they are backed by the full faith, credit, and taxing power of the issuing municipality. This means the issuer pledges its unlimited ability to levy taxes to repay the bondholders. In contrast, revenue bonds, like IDRBs, special assessment bonds, or hospital revenue bonds, are repaid solely from the revenues of a specific project, which introduces more risk if the project does not generate sufficient income. Therefore, GO bonds offer a higher degree of security due to the broad tax base supporting them. Question 13. Which entity generally regulates municipal securities firms and professionals, including the writing of rules for municipal bond market participants? A. Securities and Exchange Commission, SEC. B. Financial Industry Regulatory Authority, FINRA. C. Municipal Securities Rulemaking Board, MSRB. D. Government Accountability Office, GAO. Answer: C. Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, specifically tasked with creating and enforcing rules for municipal securities brokers, dealers, and municipal advisors. While the SEC oversees the MSRB, and FINRA enforces MSRB rules for broker-dealers, the MSRB itself is responsible for writing the rules governing the conduct of firms and individuals in the municipal securities market. For example, rules regarding professional qualifications, advertising, and fair practice in municipal transactions originate from the MSRB. Question 14. An investor buys a municipal bond trading at a discount. At maturity, for tax purposes, the discount is generally treated as A. Taxable interest income. B. Taxable capital gain. C. An adjustment to basis, no tax impact at maturity. D. Original issue discount, OID, and accreted, generally tax-exempt. Answer: D. Original issue discount, OID, and accreted, generally tax-exempt. For municipal bonds purchased at an original issue discount, OID, the discount must be accreted annually for tax purposes, increasing the bond's cost basis each year. This accreted OID is generally treated as tax-exempt interest income, aligning with the tax-exempt nature of municipal bond interest. At maturity, the bond's adjusted cost basis will equal its par value, meaning there is no taxable capital gain to report. For example, if a bond with a $5,000 par value was issued at $4,800, the $200 discount would be accreted over its life, and this accreted amount would be tax-free. Question 15. The protective covenants of a municipal revenue bond are found in the A. Bond indenture. B. Official statement. C. Prospectus. D. Syndicate letter. Answer: A. Bond indenture. The protective covenants for a municipal revenue bond, which outline the issuer's promises to bondholders regarding the management of the project and repayment of the debt, are detailed in the bond indenture. The bond indenture is a legal document that specifies the terms of the bond, including the revenue pledge, rate covenants, and other provisions designed to protect bondholders. For instance, it might stipulate that user fees must be raised if revenues fall below a certain level to ensure debt service payments are met. Question 16. What is the minimum denomination for most municipal bonds? A. $100. B. $500. C. $1,000. D. $5,000. Answer: D. $5,000. Most municipal bonds are issued in minimum denominations of $5,000, and often in multiples of $5,000. While some bonds might be available in larger or smaller denominations, $5,000 is the standard par value for bonds in the municipal market. This common denomination helps ensure liquidity and standardization within the market. For example, an investor typically buys municipal bonds in blocks of $5,000 or $10,000 face value. Question 17. The date from which accrued interest is calculated on a new bond issue is known as the A. Issue date. B. Dated date. C. Settlement date. D. Maturity date. Answer: B. Dated date. The dated date is the date from which interest begins to accrue on a new bond issue, even if the bond is delivered or settled at a later date. This is the starting point for calculating how much interest the buyer owes the seller if the bond is traded between interest payment dates. For instance, if a bond's dated date is January 1st, interest starts accruing from that day, regardless of when an investor actually buys it, ensuring a consistent interest calculation schedule. Question 18. Which of the following is typically not a factor in analyzing the credit risk of a general obligation, GO, bond? A. The issuer's debt limits. B. The issuer's ad valorem tax base. C. The feasibility study for a specific project. D. The issuer's population trends and economic stability. Answer: C. The feasibility study for a specific project. When analyzing the credit risk of a general obligation, GO, bond, analysts focus on the municipality's overall financial health and its ability to raise tax revenues to repay the debt. Key factors include the issuer's debt limits, how much debt it can legally issue, its ad valorem tax base, property values it can tax, and broader economic factors like population trends and unemployment rates. A feasibility study, however, is a detailed analysis of the economic viability of a specific project, like a new toll road or hospital, and is primarily relevant for assessing the credit risk of a revenue bond, not a GO bond. Question 19. An investor who buys a municipal bond at a premium must: A. Accrete the premium over the life of the bond. B. Amortize the premium over the life of the bond. C. Report the premium as a capital loss at maturity. D. Pay additional taxes on the premium amount annually. Answer: B. Amortize the premium over the life of the bond. When a municipal bond is purchased at a premium, above its par value, the investor must amortize, or systematically reduce, the premium over the life of the bond. This amortization reduces the bond's cost basis annually, and for tax-exempt municipal bonds, this reduction in basis is not deductible against ordinary income. At maturity, the bond's basis will equal its par value, meaning there is no capital loss to report. For example, if you pay $5,200 for a $5,000 par bond, that $200 premium is spread out and written off over the bond's remaining life. Question 20. Which of the following statements is true regarding municipal bond interest and the alternative minimum tax, AMT? A. All municipal bond interest is exempt from the AMT. B. Interest from certain, private activity, municipal bonds may be subject to the AMT. C. The AMT only applies to interest from general obligation bonds. D. The AMT only applies to municipal bonds purchased at a discount. Answer: B. Interest from certain, private activity, municipal bonds may be subject to the AMT. While most municipal bond interest is exempt from federal income tax, interest from certain, private activity, municipal bonds may be considered a tax preference item for purposes of the alternative minimum tax, AMT. Private activity bonds are issued by municipalities to finance projects for a private entity's benefit, rather than for a broad public purpose. Therefore, even though they are municipal bonds, their interest may not be fully tax-exempt for those subject to the AMT. It's important to remember that not all municipal bonds guarantee complete exemption from all forms of federal taxation, especially for high-income earners subject to AMT. Question 21. A municipal bond syndicate typically operates as a A. Clearing corporation. B. Underwriting group. C. Regulatory body. D. Trust company. Answer: B. Underwriting group. A municipal bond syndicate refers to a group of broker-dealers that come together to collectively underwrite and distribute a new issue of municipal bonds. The syndicate manages the sale of the bonds to investors, sharing the risks and responsibilities of the offering. For example, when a state issues a large bond offering, several investment banks might form a syndicate to efficiently sell billions of dollars worth of bonds to various investors. This collaborative effort streamlines the distribution process for large bond issues. Question 22. What is the purpose of a debt service reserve fund for a municipal bond issue? A. To hold funds for future capital improvements. B. To ensure funds are available for interest and principal payments if revenues are insufficient. C. To pay for the legal expenses of the bond counsel. D. To provide liquidity for secondary market trading. Answer: B. To ensure funds are available for interest and principal payments if revenues are insufficient. A debt service reserve fund is a special account established by the issuer of a municipal bond, particularly revenue bonds, to hold a reserve of funds dedicated to making interest and principal payments. Its purpose is to provide an additional layer of security to bondholders by ensuring that debt service can be met even if the primary revenue source experiences temporary shortfalls. For example, if a toll bridge's revenues drop unexpectedly, funds from the reserve account would be used to pay bondholders, protecting them from default. Question 23. An investor purchases a municipal bond in the secondary market at a discount. This discount is generally treated as A. Taxable interest income. B. Taxable capital gain. C. Tax-exempt interest income. D. An adjustment to basis, but taxable as ordinary income at maturity. Answer: B. Taxable capital gain. When a municipal bond is purchased in the secondary market at a discount, this discount is generally treated as a taxable capital gain at maturity or when the bond is sold, rather than tax-exempt interest income. This is because the discount was not part of the original issue price. For instance, if an investor buys a $5,000 par municipal bond for $4,900 in the secondary market, the $100 difference will be taxed as a capital gain when the bond matures or is sold. This is a key distinction from original issue discount, OID, which is generally tax-exempt. Question 24. Which of the following municipal bond types would be considered self-supporting? A. School District General Obligation Bond. B. Public Housing Authority Bond. C. Airport Revenue Bond. D. State Highway Bond backed by general tax revenues. Answer: C. Airport Revenue Bond. A self-supporting municipal bond is typically a revenue bond, meaning its debt service payments are generated from the revenues of the specific project it finances. An airport revenue bond is a classic example, as the bond is repaid by fees collected from airline operations, airport concessions, and landing fees. In contrast, general obligation bonds, like school district or state highway bonds backed by general taxes, rely on the broader taxing power of the municipality, not on specific project revenues, and are therefore not considered self-supporting in the same way. Question 25. The doctrine that prevents the federal government from taxing the interest on municipal bonds is known as A. The Commerce Clause. B. The Supremacy Clause. C. The Reciprocal Immunity Doctrine. D. The Full Faith and Credit Clause. Answer: C. The Reciprocal Immunity Doctrine. The tax exemption for municipal bond interest is rooted in the Reciprocal Immunity Doctrine, which originates from a series of Supreme Court cases. This doctrine holds that the federal government cannot tax the interest income from state and local government bonds, and conversely, state and local governments cannot tax the interest income from federal government bonds. This principle prevents one level of government from taxing the bonds of another, ensuring the integrity of their borrowing powers.